Between 1991 and 1998, Russian GDP fell an estimated 40%. The transition to a free market economy was plagued by hyperinflation, rising poverty, falling life expectancy and social dysfunction. Whilst the average citizen saw a marked deterioration in the quality of life, a few oligarchs became intensely rich as they bought state assets at a knockdown price. In 2000, Vladimir Putin was first elected president. Helped by rising oil prices, the Russian economy would go on to grow by 7% a year over the next decade. It seemed to ordinary citizens that the Russian economic nightmare was over. Yet, in 2025, with falling oil prices, a plunging ruble, high interest rates and Western sanctions, the Russian economy faces a new risk of crisis and stagflation. What happens to an economy can be more important than what happens on a battlefield. Nearly 2,000 years ago, the once mighty Roman Empire was starting to experience intense economic challenges. With trade declining, a succession of profligate emperors couldn't fund their extravagant spending. Soldiers started to rebel over a lack of pay, and emperors responded by printing more coins by making it with less silver. As the amount of currency increased, so did of course prices, but it didn't buy any more goods for the Roman soldier. And to deal with rising discontent, emperors just continued the debasement of a currency. By 220, the denarius was almost worthless, just 0.5% silver, and inflation was out of control. Soldiers on fixed incomes rebelled, stealing food from peasants. Civil conflict escalated. The emperors started to lose control, and the Roman Empire was never the same again. Fast forward 1,800 years, and it was modern Greece that would have one of the most dramatic collapses in modern history. After joining the euro in 2000, the Greek economy boomed, but it was under false pretenses. Greece was borrowing from European banks to fund domestic consumption. In 2008, the Greek current account deficit was a spectacular 14% of GDP. But in September 2008, Lehman Brothers went bust and the bubble burst. For Greece, it was more devastating than anywhere else. German banks wanted some of their loans back, but Greece didn't have it. Bond markets had been happily buying up Greek debt like it was the safest asset in the world. But the credit crunch and failure of credit rating agencies meant that suddenly investors thought that maybe buying Greek debt when the government was virtually insolvent wasn't such a good idea after all. Bond yields surged to 30%, not so much emerging market economy as basket case economy. And for all the talk of the euro creating European unity, the reality was that German taxpayers didn't see why they should bail out profligate Greek borrowing. The European Union pressed painful austerity on the Greek economy. Taxes went up, spending was cut, and there was no outlet like a loosening of monetary policy or a devaluation of a heavily overvalued currency. Greece was in the euro, but it couldn't get out, and the result was a bloodbath for the economy. GDP fell 30%, unemployment rose to 28%. The rate for 15 to 24-year-olds rose to over 60%. Business closed and prospects seemed hopelessly bleak. An estimated 500,000 Greeks left the country looking for better circumstances elsewhere. It caused a long-term decline in the working age population, which is yet to be reversed. And Greece was a good example of a self-reinforcing cycle of decline. As output fell, debt rose, and as debt rises, the government imposed more spending cuts. Spending cuts led to lower spending, lower output, and a whole cycle of despair. It could have been even worse without some begrudging EU bailouts. They were never enough to end the cycle of austerity, but just enough to stave off complete bankruptcy. Now, for all the talk about Greek economic collapse, recent years have proven more promising, with debt coming down from a very high level and the economy posting some impressive growth figures. But whilst the recovery is welcome, it is also a bit misleading. GDP is still 15% lower than 2008, nearly 20 years ago. The working age population has fallen by 12% and is still on a downward trend. In 1922, the German economy was buckling under the weight of post-war reconstruction and reparation payments. Similar to the Roman Empire, the government responded to worker discontent by printing money. It brought a few weeks' respite at least until workers realised the increase in wages was just an illusion. Prices were rising faster, creating more pressure for more money printing. Inflation soared, the German mark declined, and the collapse in the currency created a very real psychological shock. The middle classes who had saved for 50 years saw their pension value evaporate overnight. Money became worthless. People traded money for any tangible items, be it buttons, paper clips, or even a piece of string. The other impact of hyperinflation is that the collapse was not felt equally. Workers on fixed salaries and pensions lost out, but those who owned assets, wealth, and shares in companies were largely insulated. It was a psychological scar that Hitler would expertly exploit. You suffered, but they got richer, the calling card of most populists. However, if inflation sowed the seeds of Hitler's rise, another economic collapse was needed to bring him to power. In 1929, the US stock market collapsed after years of a scarcely credible boom in share values. Investors had borrowed to get on the act of rising prices, but when sentiment turned, people lost everything and banks went bust. At first, the Wall Street crash only affected the 10% who owned shares, but as banks went bankrupt and the government refused to intervene, the rot quickly spread. Treasury Secretary Andrew Mellon allegedly told President Hoover, "Liquidate labour, liquidate stocks, liquidate farmers, liquidate real estate. It will purge the rottenness out of the system." Whether he said it or not is rather immaterial, because that's really what happened. 500 banks went bust, the money supply collapsed, wages fell, firms went bankrupt, GDP nosedived, and unemployment soared to 25%. The only real intervention in the Hoover years was a massive series of tariffs, which caused a contraction in global trade, exporting the Great Depression to the whole world. And it created a whole generation of suffering at a time when government benefits were minimal or non-existent. The unemployed congregated in shacks outside cities, Hoovervilles, people desperate for any chance to work. On the positive side, you could say the Great Depression was so vivid in the popular imagination that by 1945 there was a wave of support for creating a welfare system, an economy at full employment. Even war hero Winston Churchill would go on to lose the 1945 election to Labour, promising a welfare state. In the US and UK, the Great Depression didn't really lead to political extremism, but back in Germany, with unemployment reaching 6 million, Hitler's message of national renewal had a whole new constituency of the despairing and angry. And one of the painful ironies of history is that Hitler's remilitarization of Germany and willingness to spend money was actually pretty successful in reducing unemployment and revitalizing the economy. It is a reminder that even when economies collapse under the weight of mass unemployment, it doesn't have to be like that. Under Roosevelt, America dabbled with the new Keynesian ideas. Some public work schemes did create employment, but the shadow of a depression never really left until 1940. In the 1970s, Venezuela was widely admired for its functional democracy and the highest living standards in Latin America, and there was good reasons to be optimistic. It had the world's largest reserves of oil in the world. Yet, within the space of 8 years, the economy lost nearly 70% of its output in one of the most spectacular collapses of a modern era. When Hugo Chavez was elected president in 1999, Venezuela was producing 2,000 terawatt hours of oil. By 2020, this had fallen to 300. Now, to retain popularity, the government funded generous welfare programs. But with falling oil prices, rampant corruption, crippling US sanctions, and falling oil output, the income just wasn't there. With social discontent rising, the government printed money to keep welfare programs going, but this of course caused the inevitable inflation. Foreign investment fled, and so did Venezuelans. Between 1999 and 2019, an estimated 4 to 6 million of the best educated Venezuelans fled the country, nearly 20% of the whole population. Venezuela, Zimbabwe, Argentina have all had spectacular collapses in recent years, but they don't really affect the global economy. But the United States is a different matter. In 1929, the US economy was around 29% of global GDP, and the US depression spread to nearly the entire world. because of the knock-on effects of lower trade, falling confidence and lower demand. In 2008, the US accounted for 26% of the global GDP, but an outsized influence on global finance. A US housing collapse, largely focused on just Florida, triggered a worldwide financial crisis and recession. Global banks buying US debt, not entirely aware of what they were actually buying. The liquidity crunch led to banks going bust from Iceland to the United Kingdom. The effect on global growth was immediate, with GDP falling, unemployment rising, and the hangover of a crisis leading to a period of austerity, growing instability, and political shockwaves throughout the next decade. Perhaps the one bright side of 2008 is that, unlike 1929, government intervention was more decisive in preventing a full-blown financial crisis. A massive injection of money kept the financial system afloat, but arguably that created winners and losers. The winners were the banks, who had precipitated the crisis. The losers were the taxpayers, who funded the bailout and largely faced a decade of austerity and lost growth. But I want to finish on a positive note, because arguably the greatest economic collapse of the last century was the state of the German and Japanese economies in 1945. In Germany, infrastructure, industry and confidence was utterly destroyed. They had lost nearly 7 million lives. Yet, slowly at first, quicker later, the economies recovered, and by the 1960s people were talking of the German economic miracle. Like a phoenix rising from the flames, is a testament to the capacity of economies to recover and reinvent themselves. Germany's economy was aided to some extent by the Marshall Plan and the relatively enlightened attitude and victory compared to, say, 1919. But to go from utterly defeated to an economic superpower in a few decades is a testament to the capacity of economies to recover. So economic crisis can have a huge economic and political effect. But it does raise the question, what are the prospects for a new kind of financial crisis focused on the United States, which of course would inevitably spread across the whole world? This video takes a look. Thanks for watching. Do subscribe and see you soon.